the investing part of the fund manager job is only 1/3 of what you have to do. You have to fundraise, then you have to actually run the fund. A lot of people who wanted to try their hand at fund management quickly realized they like angel investing and the capital deployment side of the business. They did not like the fundraising or fund management side of the business. And it's a bundle. You have to do all three.
It's the week of March 17th. Welcome to the Learning Corner, a Precursor Ventures podcast. Welcome to the Learning Corner by Precursor. I'm Mia Farnham, and I'm joined by our GP and managing partner, Charles Hudson, where we will be talking through the articles and Goodreads that we found across the past week. Topic number one, and another great episode from Strictly VC Download, where Connie Loizis chatted with Michael Kim, founder of Cendana Capital, around fund investing, focused specifically on pre-seed and seed stage funds. Cendana manages roughly $2.6 billion in fund investments across pre-seed and seed funds, and contrary to most other LPs, Michael said that last year was among one of the most liquid years from a returns perspective. Diving deeper into liquidity success, Cendana's approach to secondaries played a huge role. This, of course, is a continuing thread that we have on the subject, but I felt that Michael shared a really great line of sight to the LP perspective around secondaries. Cendana recently launched a secondaries-focused fund alongside Klein Hill, which is a private equity secondaries-focused fund to buy positions in high-quality seed-stage companies from other investors in their fund portfolio. So through this strategy, the fund is able to see the winners early on, get consistent updates about them, and work in tandem with secondary experts to ensure that exit is done in a timely manner. I'd love to get your perspective, Charles, on how the Cendana team is approaching secondaries. And is this something that every LP should be thinking about? So partnering up with secondary specific funds, or what are the attributes of an LP that make this actually a stronger strategy than others?
In a lot of ways, Cendana is one of the first and probably best known fund of funds focused on sub $100 million fund. If you're a limited partner for these small funds, when you get a winner, you might own 8 or 10% of a company where your pro rata is going to just really outstrip what you can possibly fund out of the fund. So your options are SPVs or opportunity fund. But at some point, you also might want to sell those positions, not because you don't believe in the companies, but because you want liquidity. And I think for the Cendana team, it makes a lot of sense to have a vehicle where if a manager, or already an LP in the fund, has a position that they want to sell, you could use that vehicle to buy it. And I think it's really complementary. And so I think it's really a really smart strategy. And I continue to believe that for sub $250 million funds, secondaries are going to continue to be probably the primary way that we deliver liquidity back to our LPs in the near term. Without IPOs and mega M&A, like I don't know how else you get the money back. I think it's a very complementary product to what they already do. Makes a lot of sense.
Probably calls into action, though, LPs to build even more of a higher touch with their GP. So I guess I'm just trying to think of like, how do you strike that balance of making sure that you're not being overbearing, but you are getting the best information about the winners early on?
And if you think about it, if you're Cendana, you sort of have two ways to play. You could do a direct secondary. Michael talks about this in the podcast, a direct secondary into a company that you believe in, or you could find a family office or a small limited partner who's got exposure to a fund that has a company that you care about. I think you used the example of Mucker. Well, we know what's in that fund. If we could acquire more interest in that fund, we would buy it. And so because as these fund lives get longer, you're going to have LPs who at year 10, 12 might say, I know this is a great fund. I really need the cash back. And I'm willing to sell my stake and give up the upside in order to get that liquidity now. And I think that is going to be an increased trend as companies stay private longer.
Michael also expanded on the concept of tourist fund managers, folks who just want to try on the fund manager title as opposed to really just live and breathe it. So he talked to Connie about backing founder magnet funds where founders are simply drawn to work with the fund managers through their strong reputation and experiences and knowledge. And my question is, I'm sure actually all tourist fund managers claim that they are founder magnet funds. So what actually stands out when you're looking at fund managers to back?
This is something that comes up a lot in the work I do at Screen Door on the investment committee. I almost always ask people, why are the founders that are perfectly in spec for your strategy going to choose you instead of someone else? And I think in 19, 20, and 21, we met a lot of founders who are executives at high profile companies who said, you know what I'm going to do? I'm going to use this position I have as a VP at such and such company because my company's hot. People are coming to me for advice and interest. I'm going to use that as a lever to start a fund. And I think what a lot of people realize is the investing part of the fund manager job is only 1/3 of what you have to do. You have to fundraise, then you have to actually run the fund. And what I've seen is a lot of people who started operator funds on the side or wanted to try their hand at fund management quickly realized they like angel investing and the capital deployment side of the business. They did not like the fundraising or fund management side of the business. And it's a bundle. You have to do all three. Ironically, we're also seeing some of those folks realize, hey, I like the fund management. I like the full bundle. Let me scale this up. But there were a lot of people who tried their hand at it. And I think that's fine to try your hand at it and realize this isn't for me.
What would you say for founders as they're diligencing maybe different fund managers to lead their rounds? Like, what are the flags that you'd say are there to kind of signal maybe they're not best long-term partners?
It's probably a bit self-serving, but I would say someone who's doing this as a hobby or as a side project, who's leading around, there's a chance that the demands of their day job will pick up, or they will decide they want to do this. And then the person who wrote you the biggest check and led you around is sort of out of the picture. So I think the better role for those folks is as supporting capital, but founders got to make their own decisions.
Our next topic is an article by Corey Weinberg and Anissa Gardisi from The Information, discussing Nvidia's role and the growth and success of CoreWeave, a cloud infrastructure company specializing in high-performance computing and AI workloads. More specifically, the article sheds light on how Nvidia played a pivotal role in CoreWeave's growth, using a mix of strategic investments, GPU allocations, and cloud rental agreements to fuel its rise across the AI infrastructure powerhouse. So the article shares there were circular funding arrangements between Nvidia and CoreWeave. Nvidia didn't just invest in CoreWeave from an equity standpoint, nearly $100 million. It bought back its own chips from the company and accounted for nearly 15% of last year's sales, ensuring CoreWeave's success while keeping its own supply chain in check. It's important to note that CoreWeave is projected to IPO in the near future, but findings from this article call into question how sustainable its own revenue base can be beyond major customers like Nvidia and Microsoft. So CoreWeave has positioned itself as an alternative to hyperscalers like AWS, Azure, and Google Cloud by focusing on high-performing computing and AI workloads. But when you look at its backers, Nvidia supply GPUs. Microsoft is a key investor, and even Nvidia renting cloud services from CoreWeave. No. It just raises that question, is CoreWeave truly competing with the major cloud providers, or is it just becoming another arm of the same dominant AI cloud ecosystem?
I'm very curious to see how people respond to this S1 because it feels very circular. And I mentioned this to a friend of mine. He goes, well, it's all circular because Jensen and Nvidia are making all the money. And so all of the money kind of rotates around GPU access. And if you think about it, building data centers is really expensive. And if you find yourself in need of capacity, if your choice is like, wait till you build it yourself or pay a premium to get capacity from someone who has it on demand, even if they charge you a pretty penny, just where we are in the AI cycle, I think a lot of people are like, I need the access more than I need to save the money. And I'm very curious to see how Wall Street responds to this. But if you're Nvidia, it totally makes sense. You want people your hardware. And if they can't get it from you and they can get it from a partner, why not support that partner? So I'm very curious to see how this plays out. Because if you look at the data, while there are the hyperscalers, Nvidia has been the far and away principal beneficiaries. Well, it hasn't really trickled out. And I'd be remiss if to not mention another article that The Information wrote, which was the one about Klarna. We've talked about this internally. Klarna's made a lot of claims about the G&A savings. And I read that article and I'm like, they certainly don't appear on the bottom line. They could be embedded elsewhere in the org. It doesn't look like those lofty claims about the AI savings they were getting.
Another company positioned to go
That's right.
public this year. We talked about actually the cons of having a monopoly or oligopoly a few episodes ago when we talked about advanced AI chatbots and foundational LLMs. But this also clearly applies to AI-specific cloud companies as well. So when NVIDIA, Microsoft, AWS, and Google are all funding, supplying, and effectively shaping who controls the infrastructure, they get to set the price and dictate access to compute. We're obviously already seeing this play out with smaller AI labs struggling to secure the hardware that they need to compete. Do you see a larger trickle effect into early stage startup land happening?
This is like a fundamental question I wrestle with, and I'm not a public markets person, so I don't have to wrestle with it in the same way. We are right now in a moment where the inputs for AI are scarce. GPUs are scarce. Data center space is scarce. The power, I mean, the big thing about Stargate's power, like all the things you need to scale AI are scarce. And in a world where things are scarce, if you can provide a buffer or if you can be a provider, maybe not last resort, but a provider who can bridge a capacity gap. There's always a need for that. But the question is like, what does that business look like if and when the supply chains or access to these core inputs become less constrained? Are these businesses still as good? I don't know. I'll be very curious to see, is CoreWeave still a good business 5 years from now? If the supply of GPUs expands beyond NVIDIA and other people have ways to get access to chips, metal, and all the capacity, will these still be interesting businesses?
Yeah. And it'll be also interesting because we might find find out after it's hit the public markets and everyone has jumped in. So that's something that I don't think we've seen in similar models 10, 15 years ago when companies go public.
I mean, there was a time where like bandwidth and fiber were a constraint, and then we built all this fiber and everyone said, oh no, we overbuilt it. God, we did all.
Our final topic, we're discussing a piece from Clint over at Ulu Ventures called Questioning the Conventional Wisdom of the Reserve Fund, which literally does exactly what the title describes. The standard thinking is that a VC firm should allocate a significant portion of its fund, roughly around 50% or more, to follow-on investments in existing portfolio companies. This logic is generally straightforward. You double down on winners, protect across dilution, and you maximize returns from the most promising investments. But Clint argues that this approach is flawed. He suggests that reserves may not always deliver the best returns, especially when considering opportunity cost and the difficulty of consistently picking the right follow-on investments. Instead, they propose that firms may be better off focusing more on initial investments rather than holding capital back for follow-ons. We've seen and talked about this on the pod, how firms take different approaches to reserves. Some set aside quite a large pool. Others keep it pretty lean and rely on funds for follow-ons. Given the data that's shared in the article, do you think we'll see a shift in how early stage investors manage reserves? Or is there a more underlying reason why reserves are marked off and allocated that will continue to survive no matter what the numbers say?
I think it's very hilarious we're having this conversation about the equities.
Yeah, that's true.
This is an older article. I will pull something out of the archives because I think for a long time, a lot of LPs were like, you're a seed stage fund. You should have reserves to like protect your ownership and your winners. And I've always felt that if we're getting in at very low entry prices, I really think about what's the dollar cost average entry point for us. And the more we go into companies at the A and B stage on follow-ons, the more we're kind of pulling up our dollar cost average entry point. And I talked to an LP a week ago who said, we've realized one thing, as seed rounds have gotten more expensive, if you're a seed fund that's 50% in the seed and 50% in the A, you start to look like on a blended basis, much more like an A fund on entry point, but with seed stage risk. And does that coupling make sense? I do think though, psychologically, the argument makes sense, which is like, hey, if you're going to make bets early, you should make sure you reserve a lot for the winners. And I said, well, that makes sense, provided a few things are true. You can identify the winners consistently, which I have found is very hard to do.
Early on,
you get false signal. 2, that you are willing and have access to writing your full pro rata check or whatever check makes sense in the context. Also not always the case. And 3rd, that you're actually right in the end. And I think as important as reserves are, it's one of the easier ways to blow a gigantic hole in your fund is to pile into companies that either have momentum or you think are working, only to later learn that they don't. So my philosophy has always been, if you keep your fund small enough and your first check underwriting is good, you can have a fund where the first checks can really drive performance. And I always worry more about underwriting decisions for reserves. They're just influenced by so much, how well you know the founder, how big the position is, your perception. And look, we underwrite at seed. I don't know as much about underwriting at Series C. That's not what you get paid to do.
Yeah, even just the point you raised about founders, you could have an incredibly high touch relationship with a founder and know so much about the business, and maybe the information that we'll learn, it's maybe not the best thing to follow on. I know there's a lot of fund managers, they probably just feel like they've already crossed the line and they can't go back, and they've supported them so much so they have to follow on. I think that happens when you've already allocated a specific pool and percentage of your fund because you know you're going to use it.
I can't stress this enough. I think once you're like, this money is only available for this purpose, it's restricted and you will find a way to put it. I've also felt like, some of my friends who raise opportunity funds found themselves in the same predicament. It's like, hey, I raised this pool of money. It's only for the follow-ons and my winners. I'm either not getting access, not getting the same number of winners, or the amount of money I want to write isn't in line with this fund. What do I do? Because you can't redeploy that back to the main fund.
Yeah. And also there's this risk. What if you raise the opportunity fund and you actually figure out halfway through, I don't want to deploy the rest of this into the things that I have? How do you tell that story to LPs after you've raised it and set it aside? Clint makes the case that follow-on participation isn't always necessary, particularly true for breakout companies. So once a company reaches Palantir status, investors are tripping for themselves to obviously get in, and early VCs don't necessarily need to double down. But this was also part of their shorter list of exceptions to their broader argument that VCs shouldn't default to reserving capital for follow-ons. One of those exceptions was supporting founders who haven't quite gained enough traction to attract new investors, but still have strong potential. Situations where maybe early VCs' continued backing could be a meaningful lifeline. At Precursor, we've seen firsthand how not participating in a subsequent round can be incredibly painful for founders. And navigating that decision is often more delicate than it looks on paper. So how do you kind of think about that from our shoes?
Well, I mean, there's like 2 things I'll say. One is I look at Sequoia's path with WhatsApp and just how much of that company they ended up investing in. The reserves in a big fund make sense because if you identify a winner and you have exclusive access and they like you can end up owning a significant chunk. Not only owning a significant chunk of the company, actually putting a significant chunk of dollars to work in that company. I look at Andreessen Horowitz and Databricks is probably another example. But probably one of the hardest videos, and we like to make videos for our portfolio. Probably one of the hardest ones I made was I made a video for our portfolio companies and said, listen, we don't keep a lot in reserves. And most of the reserves we keep are for the top 20% of our portfolio. And that is a moving target that's based on my subjective assessment of where we can make the most money. I've told people, you might come to me and ask for money and I might tell you no. And if I tell you no, it means at this moment in time, you are not in that circle. Because to your point about having ring fence reserves, it's too easy to be like, oh, we have the reserves. This company needs a bridge or an extension. We have a pool of money that we can use. It depends on your performance. It depends. But really, we're trying to keep that money for the top 20% of the portfolio. And that's a moving target. It's at any point in time when someone asks me, ask myself, is this one of the best investments we could make with these dollars? And because we don't hard ring fence reserve dollars, it's not like, oh, there's a pool of reserves, so I want to dip into it. It's more like I have this check. I could put it into a new company. I could put it into this company. I could save it for reserves for another company. And, Ashton did an analysis a long time ago where we looked at all of the follow-on checks we've written and whether we were enthusiastic or maybe hesitant to write it. And it turns out we're generally right. If we were enthusiastic, it was on average, it was generally a good idea. And if we were hesitant, that hesitation was oftentimes well-founded. So my conclusion is the hardest part about the follow-on reserves conversation is actually the relationship dynamic you have with the founder, not your ability to independently assess, is this company a good use of follow-on capital? The number of times where we thought it was a good idea and it turned out to be a bad idea wasn't that large. And I think that's the hard part when you have ring fence reserves. It's like the temptation is to use them, but based on the analysis we've done, the underwriting decision is easy. The relationship and the delivery of the message is hard. And I've taken the approach, if we can tell people in advance, this is how we think about follow-ons, it doesn't mean it's easy to tell somebody no, but at least they have some context. You tell them no.
Well, we are all out of time for today. Thank you, Charles, for joining us in Palm Springs at the Equity Summit. Thank you for our listeners for stopping by. Please like and subscribe, and we will talk to you with you all next week.
2 weeks in a row.
I know. Bye.